The summer predictions on gold have so far played out perfectly well. Here are the technicals that may very well have dug out gold at its very bottom. In the previous two gold episodes, we talked about a leverage short opportunity and the long-term technical map respectively. Gold did reach both its first and second short targets. However, it shook me out with a fake out before getting there. It tricked me, and that's fine, it's part of the game. But regarding the long-term bullish analysis laid out in full, the price did indeed find support at one of the two levels outlined in detail. It found support at the 1780 area. This is also where I entered a long position, this time a bigger position which amounts to 10% of my portfolio value, but this time at a humble 2x leverage, as I intend to keep it for longer and want to be able to sustain any rocky roads ahead without headaches. Let's now get into the technicals, but first, this episode is not financial advice. You must do your own research and due diligence prior to any trades. You are responsible for your investments. Never listen to anybody else's opinions, including mine. And turning on a dime, if you like this episode and if it helps you better understand where gold is at technically, then please like and subscribe, and share this episode with others who may benefit from watching it too. If we look at my long position entry, which I took at 1782, the technicals do confirm strength. Starting with the monthly chart, the price just found support at a strong horizontal level dating back 8 and 9 years respectively, just as predicted in the recent analysis episode. It also notably cooled off the monthly RSI from its early mid-80s, a level at which I did voice my concern, and down to 60, which if you can stay above here is incredibly bullish. Given that we can stay above this, what I typically refer to as the RSI motorway, as it tends to move prices fast and vigorously, gold might very well have paved the way for an exponential move. This would perfectly align with my technical theories of an across-the-board parabolic run on the global indices, as many of them do show clear tendencies of such prevised event. Moving on to the weekly chart, the price did find support on the EMA 50 and has now bounced off from it. And if you wonder why my EMAs extend further than the price action, it is because they are advanced. This doesn't mean that they are complicated, it simply means that they are adjusted to run slightly ahead of the price action. The reason for this is because it removes most noise and false signals, or false EMA outbreaks, as any break below it would technically be biased towards a trend reversal. And if you want to set them for yourself, the standard way of doing so is by adding the square root of the moving average value. In this case, we add the square root of 50, which is 7 when rounded off. These advancements are discretionary, and for best result they need to be adjusted and back tested. But this square root method should be close enough or even ideal for most of the times. This moving average advancement strategy is something we will get back to many times in the future, so we'll leave it at that for now. The weekly RSI is still in a strong channel. The only thing that would have made me over the top bullish were to be if it had bounced on the lower bullish red line. But I'm happy enough with the thorough bullish red RSI channel recharge for now. And finally, the daily chart. With the exception of this truculent fake out, the price has moved textbook delightfully in this descending channel, in which it has just hit the bottom. Normally you would never go against the trend, as in taking a long at the bottom of a descending channel, as the upside is limited and because the momentum is down. And because you simply don't mess with momentum, especially not strong momentum. The price could, for example, go sideways and leave you no upside and plenty of downside risk. The difference in this case, the very reason why we can technically justify going against the trend, is the weekly and monthly charts that both give the thumbs up for such long position. In this sense, there is a good chance we may catch this long at its very bottom, or digging for gold at the bottom. Local bottom, that is. To further support this long position, the price did find support at the EMA 200 on the daily, at which it, just like the weekly EMA 50, bounced off. This, however, is a bit abundant to even mention, as the weekly 50 will always be similar to the daily 200, whether you use a simple or exponential moving average. It's kind of like saying that 8 plus 2 is 10 and then in the next sentence proudly proclaim that 2 plus 8 is also 10. We get it, shut up. The only downside I can detect is that the daily RSI looks quite tired. This of course can change fast, but it's also the reason why I decided to take a low leverage long in case the price were to find an additionally new bottom. For only when we get an outbreak of this descending channel and a break above the EMA 50 on the daily, we can lean back and let the new momentum work its magic. Until then, however, this is a calculated risk that should pay off well in the long run, as pretty much everything on the charts scream reversal and have done so for 4 months already. In that sense, it comes as no surprise whatsoever that the price in fact did find support at the 1780 level. We knew this already back in the summer. I will keep my position for as long as it stays bullish. However, upon any break below the EMA 50 on the weekly, or shall we rather say the EMA 200 on the daily, I will release my position to reassess the situation. If it were to break below that, the next level seems to be the primary trend line, which roughly will coincide with the 0.50 fib. Upon being stopped out, that is where I will look at re-entering, unless it all proves to be a fake out, that is, in which case I will re-enter my long even more heavily, both in size and leverage. However, I technically doubt we will break below this current bottom. Target-wise, I will release 25% of my position to secure profits at the top of the descending channel, which also should coincide with the EMA 50 on the weekly. This on its own would amount to a 10% guaranteed profit, or 2.5% in total on my position. The remaining 75% I will keep at least for the midterm, as it might in fact have a lot to give. That was all for now, thank you and goodbye.